Welcome to the deep dive. Today, we're jumping straight into the stock market action.
Right.
Think of this as your quick snapshot. Pulling from live updates, this is April 24th, 2025. We're trying to cut through all the noise.
Figure out the why behind
And
that one.
exactly, focus on what you need to know without getting, bogged down in every little tick.
Precisely. Our goal is just clarity.
Right.
We're looking at the stock market today, live updates, trying to pinpoint those key forces.
Okay, so let's dive in. The initial picture looks like, well, a bit of a mixed bag, doesn't it?
Mhm.
S&P 500 is up slightly, third day now. Nasdaq's also green.
Right.
But the Dow, it's lagging, and it looks like IBM is a big part of that story.
Yeah, that's a significant drop for IBM.
Yeah.
It really highlights the divergence.
What does that divergence tell us right off the bat?
Well, it's interesting. You've got the tech-heavy NASDAQ gaining, but the Dow, with more industrials, struggling,
Yep.
especially with a big name like IBM weighing it down.
So different sectors reacting differently?
Exactly. It suggests different factors are hitting different parts of the economy. It's not like the whole market is moving in lockstep.
And speaking of factors, trade seems to be back in the mix, or maybe the lack of it.
Ah, yes. Trade uncertainty?
Sounds like China came out pretty clearly saying no talks are happening right now, dismissing progress reports.
That's right. They're pushing back, even calling for the U.S. to cancel those unilateral tariffs.
Which is quite a contrast to some of the more maybe optimistic comments we heard from the U.S. side recently.
It really is. It just underscores how volatile this issue is, how sensitive the market is to any whiff of news or non-news in this case.
Yeah.
And remember, that U.S. tariff on Chinese imports is, what, 145%? It's huge. So any shift there gets a lot of attention.
Absolutely. It feels like we're always decoding those statements.
Yeah.
Okay, shifting gears slightly. There's this discussion around the IMF.
The mission creep accusation.
Right, from Treasury Secretary Bessent. He thinks they're spending too much energy on climate, gender, social issues, things he says are outside their core job.
And Kristalina Georgieva, the IMF head, she pushed back, didn't she? Said there's maybe a bit of confusion about their role.
Yeah, she even mentioned they don't actually have climate experts.
Right. Her point seemed to be that when they advise vulnerable countries, like Barbados on extreme weather, it's strictly from the macro side, the economic impact side.
So what's the bigger picture here? Is this about the changing role of these big financial institutions?
I think so. It's this ongoing debate, really. You have Bessent wanting a very traditional focus, strictly economic stability.
And Georgieva may be seeing that broader global challenges, even if addressed through economic policy advice, do have major economic consequences.
Exactly. Especially for vulnerable nations. It's about where you draw the line on their responsibilities in today's world.
Okay, interesting debate. Let's get back to the market itself. Individual stocks. We're seeing some pretty big reactions to earnings reports.
Definitely. That's where a lot of the action is.
On the upside, Texas Instruments really jumped. Beat expectations, strong guidance. ServiceNow, too, right? A big pop there.
Yeah, those are good examples of the market rewarding strong performance and positive outlooks.
So it's not just the past quarter, it's the confidence about the future.
Absolutely. When a company beats and says, hey, we think things look good going forward, investors really like that signal. It suggests more profit down the line.
Makes sense. But of course, it's not all positive reactions. We've got some notable negative ones, too.
Right. IBM, for instance.
Yeah, IBM stock is down, even though they actually beat earnings estimates. What happened there?
It seems to be the CEO's comments. He sounded cautious, mentioned near-term uncertainty making clients pause and take a wait-and-see approach. That language clearly spooked investors.
So the outlook trumped the earnings beat.
Looks like it. And we saw something similar maybe with Procter & Gamble. They dipped too.
Yeah, P&G's revenue missed expectations, even though earnings were slightly better, and they lowered their full-year outlook.
See, revenue miss, lowered outlook. That overshadowed the small earnings beat.
And Chipotle, shares fell there too.
Weak revenue, and crucially, their first drop in same-store sales since, 2020? That's a red flag. And they also lowered their outlook.
So these examples really drive home that point. Just hitting the profit number isn't always enough anymore.
Not at all. The market digs deeper. It looked at revenue trends, listens very closely to management's tone, their guidance, the whole story, really.
Okay. And it's not just single companies flashing warning signs. What about the airlines? Seems like there's some industry-wide concern brewing.
Yeah, definitely seeing some caution signals there.
Southwest is cutting flights for the year, pulled its 2025 and 2026 EBT guidance, citing weaker domestic bookings.
That's significant. withdrawing guidance that far out suggests real uncertainty about future profitability. And EBT, for listeners, that's earnings before taxes. It's a key profitability measure they're now unsure about forecasting.
And American Airlines also pulled its 2025 guidance. Due to economic uncertainty, they said, even though their recent earnings per share actually beat expectations.
Right. That's telling, isn't it? Beating recent numbers but still too uncertain about next year to offer guidance.
So what does this collective airline caution suggest?
Well, airlines are super sensitive to the economy, right? Consumer spending, business travel. So when they pull back like this, cutting flights, withdrawing forecasts, it signals they might be anticipating weaker demand ahead. Broader economic worries, basically.
Okay. We also saw an analyst downgrade, Mondelez International.
Yeah, D.A. Davidson.
They downgraded the stock due to valuation concerns, even while slightly raising the price target, which is interesting.
A bit counterintuitive, maybe.
Their reasoning mentioned soft snacking demand in the U.S., a mixed outlook in emerging markets, and also that the stock price already kind of reflects the recovery in cocoa prices.
Right, so this is a great example of analysts looking beyond just the latest earnings report.
Oh.
They're factoring in consumer behavior trends, that soft snacking demand. They're looking at the global economic picture mixed outlook overseas. And they're considering input costs and current valuation cocoa recovery priced in. It's a much broader, forward-looking assessment.
So even with a slightly higher price target, they're saying the risk profile or the immediate upside isn't as attractive anymore.
Exactly. They're essentially saying maybe the stock's run its course for now, given these other headwinds.
Okay. Now, here's a perspective that might throw some cold water on the recent market gains. Wolf Research.
The bear market rally idea.
Yeah, they're suggesting this recent climb might just be a bear market rally, which they describe as potentially the most violent kind. What does that mean?
Well, basically, during a longer-term downturn or bear market,
Yeah.
you can get these sharp, powerful bounces higher. They feel like a recovery, but they don't last. They eventually fizzle out, and the downtrend resumes.
So Wolf is saying, don't be fooled by this.
Pretty much. They acknowledge some positive internal market signs recently, but they think the bigger picture, the longer-term trend, still points downwards.
Are they looking for specific signs of a real recovery?
Yeah, they mentioned needing to see the S&P 500 get convincingly above certain resistance levels, specifically that range between 5,500 and 5,700.
And where did the S&P close yesterday? About 53.75.
Right, so still quite a bit below that key zone they're watching. It adds a layer of caution to interpreting these recent green days.
Definitely something to keep in mind. And adding yet another layer of caution, Deutsche Bank analysts have a take on recession risk.
Okay, what are they saying?
They're arguing the market hasn't actually fully priced in the possibility of a recession, even with all this tariff talk and uncertainty.
Interesting. Why do they think that?
They're comparing current market behavior to previous pre-recession periods. They say we haven't seen equity declines as deep as usual. Or credit spreads, the difference in yield between risky and safe debt, haven't widened as much. And oil prices haven't dropped as significantly as they often do before a recession.
So their point is, if the market was truly anticipating a recession, we'd likely see more pronounced versions of those signals already.
Exactly. And their conclusion is pretty stark. If a recession does materialize, there could still be significant downside risks for stocks because that possibility isn't fully reflected in current prices.
Wow. So that's a warning that even with recent worries, the market might still be too optimistic if things really turn sour economically?
It seems like it. So putting it all together,
Ugh.
wow. It's a really complex picture today, isn't it?
It really is. You've got some positive momentum, like those tech earnings reactions.
Right, but then you balance that with big concerns, trade tensions flaring up again, those cautious outlooks from IBM, P&G, the airlines.
And the broader economic questions hanging overhead, plus the fact that different stocks and sectors are moving so differently really tells you, well, you can't just look at the main S&P number and know the whole story.
Absolutely not. And then you throw in the debate about the IMF's role and these clashing perspectives on the market itself. Is it a bear market rally? Is a recession priced in or not? Lots to juggle.
For sure. But understanding these dynamics, how the market reacts to trade headlines or looks beyond the earnings number to guidance, and appreciating these different views on the overall trend, from Wolf's caution to Deutsche Bank's warning, that really helps you process the information overload.
Yeah, hopefully helps you make more informed decisions for your own situation. That contrast between the bear market rally idea and the recession not priced in argument Really highlights the uncertainty out there.
It definitely does. It underlines the need for a nuanced view, not getting swept up in just the day-to-day movements.
Okay, so to leave you with something to think about, given all these conflicting signals we've talked through, the good earnings here, the cautious warnings there, the big macro uncertainties, what are the key indicators you are going to be watching closely over the next few weeks? What will help you get a clearer sense of where this market is actually heading?
Good question to ponder.
Think about how things like trade developments, individual company results, maybe inflation data, how they might shape your perspective going forward. Thanks for taking this deep dive with us.